A very good day to Dr. Azli and my fellow friends. So we are from Group 2 and our group members are Nazrin, Siti Rauda, me myself, Sri Ashwa, Siti Saada, Arfan Ajwa and Shafiq Abid. So today we focus on the case study of Northwest Company using the fishbone diagram analysis. So for the overview of the company, NWC, which is Northwest Company, with a 350 years history, is a growing food retailer headquartered in Winnipeg, Manitoba. Known for operating in markets often avoided by larger retailers, NWC's total sales reached CA 1.6 billion US dollar in 2014. The company generates 78.2% of its revenue from food sales and operates under various banners, serving remote communities in Canada, Alaska, the South Pacific, and the Caribbean. Notable international acquisitions include the Alaska Commercial Company in 1992 and Cost U Less in 2007, with international sales accounting for 35.8% of NWC's business. Next is the first question, which is who is the decision maker in this case and what is his or her role in the case? So the decision maker is Angela Robinson. A junior analyst is tasked with the critical responsibility of reviewing the performance of Northwest Company to determine its suitability as an investment candidate. Her comprehensive assessment will focus on NWC's profitability in both Canadian and international operations, and she will thoroughly analyze NWC's financial structure. This analysis is crucial as it will provide insights into whether and how future expansion could be financed, ultimately impacting the decision to either reject NWC as an investment candidate or proceed to the next phase of analysis.
Hello everyone. Today I will be discussing the key difference between remote food retail markets and mainstream food retail markets for the Northwest Company or NWC. To begin with, let's talk about mainstream food retail markets. These markets are categorized by a broad range of product offerings. Customers can find a variety of goods from good to pharmaceuticals, clothing, electronics, and household items all under one roof. The competition is intense with major players like Loblaw Companies, Empire Company, Metro Inc., Costco, and Walmart leading the market. In this market, consumers benefit from lower price due to high competition and efficient logistics. The convenience of one-stop shopping, price sensitivity, and increasing demand for healthy food options are key drivers. With nearly no switching costs for consumers, retailers are under constant pressure to maintain competitive pricing and product variety. Now, let's shift our focus to the remote food retail markets where NWC operates in northern Canada, rural of Alaska, the South Pacific, and the Caribbean. These markets are vastly different from the mainstream markets. Firstly, remote markets are characterized by limited product offering and significantly higher prices. For instance, a basket of groceries costing $113.99 in mainstream market could cost as much as $219.90 in northern markets. The high price are primarily due to the extensive transportation and logistical challenges involved in serving these areas. Secondly, there are fewer competitors in remote markets. As of early 2012, NWC operated 127 grocery stores in northern Canada, whereas Arctic Cooperative Ltd had only 31 stores. This limited competition results in less price pressure but also fewer choices for consumers. Thirdly, operating in remote areas comes with high costs. Transportation is a significant expense as many items need to be flown in due to long distances and difficult logistics. Additionally, costs related to storage, inventory management, labor, building maintenance, and electricity are much higher than in mainstream market. To mitigate some of these costs, the federal government's Nutrition North program provides subsidies to offset the transportation expenses for 103 remote communities. However, these subsidies mainly cover transportation and do not address other operational costs. Despite this support, the price of food remains a substantial challenge for both consumers and retailers. Lastly, high food prices in remote areas raise a significant ethical concerns and campaigns like Liz Papazzi's Feeding My Family highlight the difficulties faced by the northern communities, particularly Inuit communities, in accessing affordable and healthy food. The viability of these communities is a pressing issue with an ongoing debates about how best to support them. In conclusion, while mainstream food retail markets benefit from extensive competition, variety and lower prices, remote food retail markets face unique challenges. High cost, limited offering, and ethical concerns define the landscape in which NWC operates. Understanding these differences is crucial for evaluating NWC's performance and its strategies for future growth.
Okay, for the third question is how has Northwest Company performed financially? At the right of my slide is the consolidated statement income 2014 and 2015. And the left of my slide is the revenue cost and margin analysis from 2013 until 2015. Northwest Company revenue increased from 1,543,125 in 2015 to 1,624,400 in 2015, representing a growth rate of 5.27%. While this growth is positive, actually it remains modest when compared to the industry average of 31.6% during the same period. However, the cost of goods sold, which is COGS, increased by 6.63% from 1,088,071 to 1,160,182 dollars. And despite the revenue growth, the cost increased at slightly higher rate, leading to a gross profit margin of 28.58% in 2015, which is lower than the previous year's industry average of 24 until 25.2%. So this suggests a tighter margin and highlights rising cost pressures that the company may need to address to sustain profitability. The company earnings before income taxes slightly decreased, which is 92,276 in 2015 to 90,793 in 2015, which is a decline of 1.61%. Actually, this decline in earnings, coupled with a relatively stable income tax expense, will result in a net earnings decrease of 2.55% from 64,263 to 62,883. So actually, this Northwest Company's return on sales for 2015 was 3.87%, which quite low and remains above the industry average of 1.4 until 3.5%. The return on equity (ROE) was 19.3%, which is quite significantly higher than the industry average of 9 until 18%, indicating that Northwest Company actually was more efficient in generating profit from its equity base. Northwest Company current ratio, which measure its ability to cover short-term liabilities with short-term assets, improved from 1.47 in 2015 to 2.1 in 2015. So this ratio is well above the industry average of 1.6 until 1.7, indicating a strong liquidity position. And then this debt to equity ratio, however, was 1.2 in 2015 and down from 1.63 in 2015, indicating that the company has successfully reduced its reliance on debt financing, this is a good improvement in leverage along with a substantial increase in non-current assets by 9.97%, which reflect a solid financial foundation.
Okay, for the next question is question number 4. How does the firm's domestic performance compare to its international performance? So in this section, I will be presenting about 3 characteristics which are sales, EBITDA and number of stores and employee for both segments. And the next presenter will explain more on other characteristics. And in this section, I take the figure from 2014 for both segments. So for the first characteristic, which is sales, the Northwest Company reported sales of 1,042,105 168 Canadian dollars for its Canadian operation, with the increasing of 1.875% from 2013. This figure highlights the company's robust presence in the Canadian market, reflecting its successful retail strategies and strong consumer demand. While international operation, the Northwest Company international operation achieved significant success, particularly in the region, reporting sales of 582,232 Canadian dollars, with the increasing of 11.9376% from 2013. This impressive figure reflects the company's strategic efforts to expand its market presence and enhance its distribution channels outside its home country. For the next point is EBITDA, earning before interest, tax, depreciation and amortization. EBITDA is a key financial metric used to assess the company's operating performance by stripping out non-operating expenses and non-cash charges, providing a clearer picture of operating profitability. So, for domestic performance, Northwest Company reported an EBITDA of 100,896 Canadian dollars for its domestic operation. This figure highlights the company's ability to generate earnings from its domestic operation before the impact of its capital structure, tax regime, and accounting decision related to depreciation and amortization. For international operation, the Northwest Company reported an EBITDA of 36,952 Canadian dollars for its international operation. This figure suggests that the international segment of Northwest Company was generating substantial operating earnings and reflecting its efficiency and effectiveness in managing its operation abroad. This performance could be indicative of strong revenue streams and effective cost management practices in their international market, contributing positively to the overall financial health of the company. For the last characteristic is number of stores and employee. Domestic performance of the company included 178 stores employing about 4,921 people, reflecting a substantial workforce to support its extensive retail presence within the country. On the international front, the company operated 47 stores with 1,726 employees, indicating a more focused but still significant overseas market presence. The disparity in store numbers and employee count between domestic and international operation suggests that while the company had a strong local foothold, it was also actively expanding its global reach. This balanced approach likely aimed to capitalize on domestic market stability while tapping into the growth potential of international market.
The next characteristic is market conditions. Domestic market in the Canada is characterized by limited offerings and higher prices. This is mainly due to the fewer competitors. This allows NWC to maintain higher profit margins. The remote northern Canadian communities rely heavily on NWC, giving the company a strong market position and ability to charge premium prices. For the international market are more competitive. NWC operates in the region like Alaska and Caribbean, where competition is stiffer, requiring the significant capital investment for the infrastructure, supply chain, and marketing. This market demands strategic management to navigate the local regulations, cultural differences, and the market dynamic, making the profitability harder to achieve. And the last characteristic is profitability. In the domestic market, NWC benefits from a stable and profitable operation despite of higher cost of goods sold due to the logistical challenges. Limited competition allowed for the higher prices, leading to the consistent profitability even in the higher costs associated with the remote area logistics. And for the international market, internationally the profit potential isn't as high This market requires heavy investment and profitability can impact by factors such as exchange rate, fluctuation, and differing market dynamic. Each market poses a unique challenges from economic condition to consumer behavior, adding the complexity and the cost.
So this is the fishbone diagram that evaluate NWC as a potential investment. So there are six elements, which is the first one is financial performance, market position, operational efficiency, risk factors, strategic initiative, and last but not least is economic condition. So under financial performance, there are three sub-elements, which is revenue growth. Under page 7, NWC reported revenue of current assets 1.648 billion in 2014 and has average annual increase of 5%, showing steady growth over the years. And the next one is profit margins. The evidence is come from page 7 also, where the profit margins remain stable at approximately 31% in 2014, which stable profit margins indicate efficient cost management and the ability to maintain profitability. And last but not least is return on equity, where the return on equity has increased from 12% to 14%, that demonstrate better utilization of shareholder equity to generate profits. Moving on to market position. Under market position, there is two sub-elements, which is geographical reach, where the evidence come from page 3. NWC operates it remote and understand markets in Canada and Alaska and has successfully expanded into three new regions, and it contribute to overall revenue growth and market diversification. And the next one is brand recognition, come from page 1, where the customer base has grown by 10% annually and has strong brand presence in remote areas through well-known store brands like Norton and Norton Mart. The third element is operational efficiency. So the first sub element is supply chain management, where the evidence come from page 1 and page 3. NWC has adapted its supply chain to manage high shipping costs and logistic challenges in remote areas. Efficient supply chain operations are crucial for maintaining profitability in high cost market. And the next one is cost control, come from page 5, where the company has implemented cost saving measures to reduce operating expenses by 3% over the past year. Effective cost management strategies help NWC sustain its profit margins. So the fourth element in fish diagram is economic vulnerability. The company's market are economically vulnerable with lower than average incomes, which economic downturns in these regions could negatively impact sales for NWC. And the next one is current fluctuation, where the evidence comes from page 3. NWC operates internationally, exposing it to currency exchange risk. Unfavorable currency fluctuation can affect profitability. And the last one is operational challenges, which is come from page 3. High shipping costs and logistical issues due to remote location. These challenges could lead to increased operational costs and affect their profit margins. And the next one is strategic initiative. The first sub-element is expansion plan. The evidence is come from page 2. NWC expanded into the Caribbean and South Pacific regions through the acquisition of CosULES in 2007. This was a strategic move to diversify its market and presence beyond Canada and Alaska. And the next one is new product lines, which come from page 2. The introduction of organic and health-focused product lines has resonated well with consumers and contribute to revenue growth, which is cited from Alex et al. In 2014. And the last one is economic condition. where the case highlight that the periods of economic stability has growth and lead to higher disposable income for consumers. This increase in disposable income translate into greater consumer spending on both essential and non-essential goods, which benefit NWC directly. NWC experienced a 7% increase in sales compared to a 3% increase during less stable times. So to conclude, based on the detailed analysis, the investment fund company should continue evaluating Northwest Company as a potential investment due to its strong financial performance, consistent revenue growth, stable profit margins, indicate effective cost management and operational efficiency. NWC's high return on equity highlights its profitability and its unique market position in remote and undeserved areas and reduce competition and enhance customer loyalty. The strategic acquisition of Cosules in 2007 diversifies its revenue streams and provided growth opportunities. However, it is important to consider the economic vulnerabilities and operational challenges NWC faces, such as high shipping costs, logistical complexities, lower income levels in remote areas, and currency fluctuations in international markets. So these factors could impact profitability, requiring continuous risk management. Therefore, while NWC shows promising strengths and opportunity, the investment decision should include a thorough risk assessment to align with the investment fund company's objective.